Day trading stocks using the VWAP, which is a volume weighted average price. This is gap edge trading. I've technically trade gaps and momentum moves, and I've always used the VWAP as a guide for entries, extreme moves, pull-aways, or pull-ins. And this is what this educational video is to go over, to show you how I use it and how you can incorporate it into your trading. The purpose of this course is threefold. First of all, to define the definition of what the volume weighted average price is, using the VWAP for target areas, and thirdly, using the VWAP as measurement of proper entry areas. I'm going to go over all three of these in this course. So let's get the definition of the VWAP. The volume weighted average price is a trading benchmark used especially in pension plans. So this means it would be large institutional traders that would be using the volume weighted average price in their trading. And so the reason we want to pay attention to it is because they cause enormous spikes in volumes at certain areas. So the VWAP is calculated by adding up the dollars traded for every transaction price multiplied by the number of shares traded, and then dividing by the total shares traded for the day. And there's a formula there, and that would give you, at that moment in the intraday time, the VWAP is going to tell you what that average is. Now the average changes throughout the trading day. As time progresses, more shares are traded at a certain price, or higher price, lower price, middle price is going to adjust the volume average price. So it is a moving indicator. It does move with the price action. So it's good to pay attention to it, and I'm going to go over some details here with you. So the volume average price, the VWAP, is a tool to identify liquidity points. As a volume weighted average price measure, the VWAP reflects price levels weighted by volume. This helps institutions, which I previously mentioned, pension plans, and large traders that trade their trading desk with their orders. So they use it as a benchmark. So the idea is not to disrupt the market when entering large buys or sell orders. So they want to trade in direction, in coincidence, in relationship with it. So the VWAP helps these institutions determine liquid and illiquidity price points for specific securities over a very short period of time. And as a day trader, that's exactly what we're doing. We're trading over a very short period of time. Now, I want to keep this teaching course very simple, because I don't want you to overanalyze the volume weighted average price. So this is a guide to show you how to incorporate it into your trades. Okay, so the VWAP can be used to measure trading efficiency for these larger players, the banks, the institutions, the pension funds, how they use it. All right, they use it as a guide for them, how well they've done. It's like after buying or selling a security, institutions or individuals can compare their price to the VWAP values. So a buy order executed below the VWAP for a desk trader at a large firm, he would be considered a good fill because the security was bought below the average price. And conversely, a sell order executed above the volume average price would be deemed a good fill if it was sold at an above average price. So it's basically a benchmark, and so they're trying to trade in relationship with the VWAP. And if they're moving a lot of volume, which they do, and they're trading large orders at certain price points, don't you think you would want to pay attention to that, or have an awareness or a knowledge of this potential benchmark or guide that could show you where large trades are going to be going on or off? Exactly right. It's what I thought. So over the years, I have used the volume average price, and as I've been day trading for over 10 years, and it's pretty much become a main item I use on my chart. Now, when I first started using it in my teaching courses, I never showed it to anybody or talked about it because I didn't want to create a lot of confusion, because I was still working on the process for myself and understanding it. And over time, it just became a very consistent tool, noticing the trades were going off near or around those areas, and how the VWAP is kind of like a mean. It's like when price gets far away from it, it comes back up into. So I'm going to show you a couple scenarios in this course in the way that can help guide you to better trading. Okay.
Now, I specifically use, obviously, first specifically, I'm gap edge trading, so I specifically trade gaps, and I also trade momentum moves that occur during the trading day from news. Basically, gaps are caused by news, either post or pre-market before the market's open, and the gap occurs because of the news. And the market opens, the stock opens up at a lower, higher price based upon the news that was released. Now, momentum moves are the same category, but they happen during the market hour. So they have they're the same relationship. The volume, the news, the fluctuation in price action creates opportunity. And so combining these two categories, trading gaps and momentum trades, based upon news and the fluidity of the way that they move up or down, tying the VWAP into that can help you out immensely. Okay? So number one, gapping stocks, which I just went over, up or down gaps. And number two, momentum moves, stocks that rips or dips big intraday based upon news similar to a gap that occur in the post and the pre-market, where a momentum move occurs during the trading time because it's just news was released, speculation or a rumor or whatever. It all causes the stock to move, and that's all we really care about as day traders, is we care that the stock's moving. We want an opportunity. And so to tie in the volume average price into these two categories is going to help you define a greater edge than I've already given you in the previous courses I've done. So both types of moves are off related news and tend to trade above average volume, which moves more in tandem with the VWAP. I classify these two gaps and momentums as stocks in play. So basically I'm saying that gaps and momentum I classify as what we would call stocks in play. That means they have above average volume, they're reacting to some sort of a news, there's a lot of energy behind them, and they create opportunities to day trade long or short because of the momentum, above average volume, and a lot of energy behind the news that came out. So meaning the stock institutions are in play because these moves are the ones that the institutions are moving, and you want to pay attention to the volume and average price because it has to do a lot with the way that they trade around price. So if they're trading around the price with the VWAP, you want to be very aware of what they're trading around so that you can capitalize and make money with them. Basically, as a day trader, individual retail trader like myself, we're not the ones that move the market. I mean, obviously, if you haven't noticed that, we trade with what's going on. The clues are there, the footprints are there, the bigger money. We just get on the back and ride the horse in with the stampede. So if they're paying attention to the VWAP, you want to pay attention to it, and that's exactly what this course is about. Okay, so here's an example using the VWAP in trading. Example of a stock that had an intraday rip. See the rip? This is a 1-minute chart of Halliburton. It ripped up because there was a rumor, or there wasn't a rumor, it was actually real news that they were going to buy Baker Hughes, or Baker Hughes is going to buy them. So both the stocks exploded to the upside. And I don't really care about the news. As long as it's not a buyout and it's a sealed deal on a buyout, I'm going to trade it. Okay, so this wasn't a sealed deal, and it eventually fell out of the news next day, so it didn't happen. As the price moves far away from the VWAP, which is the red line, it was the blue line that turns red. Once the price goes over, it turned red. And becomes far away from the price, it becomes more tempting to get a short entry. So price tends to gravitate back towards the VWAP. Now remember, the VWAP is just basically telling you where everybody owns the shares for the day at the average price. So basically the trading has been going on for 4 hours, and all of a sudden there's this big burst up, volume shoots up, the stock goes way up to $58. It was at below 51, and the majority of the trading action in the day, once this news came out, was about 52, and with the big push up, pushed up the majority of owners were holding the stock about $53. Okay, so still far away from the VWAP, the volume weighted average price. So as a trained trader like myself, and I teach other traders to do the same thing, you have the volume average price as a potential target area. Now, reason being, it's a fluid move to the upside, meaning the stock exploded with a rip. You got one green bar in the minute, 2, 3, 4, 5. You get one stall bar, 6, 7, 8, 9, 10 with a doji bar on the 1 minute. It's a very explosive move to the upside. you have to be, if you're any bit trading experiences or you're just beginning to learn, you want to make note of these because these can be potential reward trades. Meaning, this trade actually happened towards the end of the day. So it was, I think it was a Thursday towards about 3 o'clock that this occurred. It was like actually 3:30. So there was only about a half an hour left in trading, which I typically don't like to trade that last hour anyways, but the trade was too much to pass up. So I waited, and so I'm trying to show you the logic behind using the VWAP here. So the price extends far away from the VWAP in a quick momentum, which I call a RIP, news out intraday. This gives me an idea that I want to be short based upon a technical entry off a candlestick. And I short under the Doji 1 minute bar at 57, under 57. That's about $1 stop, right? So I potentially could be wrong and lose $1, but I potentially could be right and make $3 to $4. So it's pretty good odds, at least 3 to 1, maybe 4 to 1 if the trade goes well. So here's how it played out. So stock rips up on the news intraday, which is we call a rip, momentum move. You take a typical chart entry, short under the 1 minute bar, and the topping bar, and you aim for your target to be around into or near around the VWAP, which is around 53. So you're looking for the price to drop near into it. You won't always get it, but you're talking pretty darn close. I mean, this is where the stock actually closed at the end of the day. But it just shows you the power behind this volume weighted average price. It is the mean. When something gets far away from the mean, it drops back into it. It's a real science, mathematical equation. Very simple for mathematics here. So, stock rips up on momentum. We call it a rip intraday. You're watching it. You see the stock is way extended far away from the volume weighted price, so you know the potential is you have a odds of the stock coming back into the mean, which is the VWAP. And you look to get short, find an entry, and you get short, and the stop comes all the way in. So it's a beautiful setup. Right here's just the opposite, right? This was a news of I think they had some accounting issues, or this is actually a 15-minute chart. So that one was a 1 minute. This is a stock that sold off all day, gapped down, sold off all day, and 10 o'clock West Coast time. So it was pretty close to all day. So the momentum on the price moves far away from the VWAP. You should be watching it for a potential reversal to at least get a bounce into the VWAP, which the VWAP is about $1 away, about $1.20 away, which is pretty good. So you see it's far away from the VWAP because what I'm going to say to you is if this stock had been trading all day long and the VWAP was right at $20, I would not look to trade a bounce reversal. Because I want the price to be away, because eventually my first potential target area to unload some shares on this price action is into the volume average price. That's my first potential target. After that point, I'm looking to trail it and see if I can get more. Okay, so let's see how this happens. So you can see there's a 15-minute reversal takes place. So in this trade, you're looking for VWAP to be a place you are looking to lock in some profit and show the reminder of the shares you've taken out of the position. So basically, you got an entry at 1980 over the green bar on the 15-minute stops 1956. You unload some shares into the volume weighted average price about 2050. So you made 70 cents on half. You trail the back half, you make another buck on the back half into the close. So from these two scenarios, I've shown you both stocks have gotten far away from the VWAP, had above average volume intraday. We're reacting to some sort of news, and you looking for the VWAP to be potential point of a target and beyond some. So don't be gravitated to the fact that it hit the VWAP and you take it all. Well, you may want to see if you can get some more out of it. So this one proved that fact that it did pay more. Okay, now here's a stock that gapped up with Halliburton the next day after the news, which was Baker Hughes BHI, and it gapped up. Thursday was the momentum move, and Friday it gapped up, and so basically just kind of went soft, right? You can see the 5-minute chart here, and it just kind of started leaning away, Most of the day it was below the VWAP, but it didn't really have a big momentum. You could have played a 5-minute reversal and a bounce into the VWAP. That could have been very, paid very successfully. But the point I'm trying to show here is the VWAP at the first test was a point of supply, where the stock, retraced back up into it from the lows, and then sold back off. Now, you're saying to yourself, in the last point, you're pushed over the VWAP, and it was a bullish move. First of all, I would never look to short the second retest of the VWAP, because the stock never made a new low on the day. It made a higher low. So technically, it's performing quite well by holding the lows and not making a new low. But the fact that it pushed up over the VWAP shows you that there, and you can even see the volume spike here. See the volume spike? I got this sign over it here right now, pushed over VWAP. You see that? That's the institutionals, like I showed you earlier, that they're playing into that. See, they're trading their large orders around this area. So it's a huge order. So they either probably selling here, right? And then they were buying here. Now, who knows why, whether they were buying or selling, but this is exactly what happens. So, as you are as an intraday trader, if you're not paying attention to the volume average price, you're doing yourself a disadvantage to yourself, because you don't know what the larger players are doing. So no extreme moves on this gap, but it made a simple point at the VWAP, later pushed up through it and closed over it. The first touch could have been used as a sell setup, right? Rightfully so. Or you could have caught the reversal on the 5 and caught a bounce into it. And the second one was a little close to the prior price action to sell into. Like I said, didn't make a new low. But showing you, what I want you to do through this whole process of learning to watch the VWAP is to see what it's doing and how you can incorporate it into your trading. So to know that larger players are using it, they're being graded off of it, it's very important. So when they're getting their grade for the day as an institutional trader, they're going to be graded upon, like I say, for instance, John Smith runs a desk at JP Morgan in New York City. He is senior trader, has been on the trade desk for 15 years. He gets an order from his boss that somebody wants to buy 5 million shares of BHI and wants the order fulfilled today. And so he has to execute the order. So his duty as a trader is he's going to be graded on how well he traded around the VWAP. Now, ideally, he wants to buy underneath it, because that's going to make him look like he's a better trader. He got his client a better price below the benchmark. So by being aware of that, you know that a lot of trades are going to be going around this price action. So you need to know what you're seeing, what's going on, incorporate in your trading. So this is a good example of that. Now here's a stock that gapped up on a Friday, and well, gapped up because I think the CEO bought 25,000 shares. Okay, so it caused a little momentum, and so P was a strong momentum move. Now, the stock, the first 5 minutes broke above the VWAP, which I'm not too really concerned about, and it had a nice momentum move. But you see how it pulled back into the VWAP and met as an area of support and demand. And technically, it's a support and demand level, but you can see the buyers came in and they scooped up the shares. So it looked like it was almost going to break down a little bit, and people had their stops in a little bit too tight. They probably got short on a failed buy setup on the 5 minute. But if you'd have bought into the 2050 price, you would have made a buck into the day, because it went up to what 2050 was the buy area at the VWAP, and it went all the way up to 2160 by the end of the day and closed at 2152. So P was a strong momentum move, and later pulled back into the VWAP, creating a very nice buy setup. Reminder: VWAP is a guide when setups follow into it. So the whole thing in trading this, being aware of the VWAP, is to know what's going on around that price action. So if I, for example, if I was looking to buy P, which is Pandora, and I missed the entry at the open and it went right up, I'll be looking for a pullback. I want to buy some kind of a slop and drop where people get shaken out. I want people to be tricked and thinking to get short on a bullish move, and I want people to get shaken out and have been long all day, and then I want to pick their shares up. So this is exactly what happened. Somebody was thinking, let's short this equity below the 5 minute sell setup. Failed 5 minute buy setup, and it went lower and shook out the longs, and some got short, and then they were forced to buy their way out the cover. So you as a trader, you're looking for these key points of reference of buying into the VWAP, because remember, the institutional traders are using this as a benchmark for their trading. So whoever scooped those trades up, shares up, probably got a good deal. You can see there's a higher bar there also at that time, and so there's a little bit of volume coming into that area, so the buyers went down there to snatch it up. So VWAP is very important. So in this short little course I've done on the VWAP, I want you to be aware of it in your trading. I want you to have it in your chart. I use TradeStation. They provide the VWAP is one of their indicators you can incorporate into your charts, and it's done. Now the VWAP will change a little bit. For instance, when you use the pre and post market, because it includes the volume from the pre and post market. Now, as a gap trader, I'm always including the pre and post market in, because it's really giving me the average. So, like, say Qualcomm gapped down in the post market on earnings and gapped down $5 and did 5 million shares in the after hours. Well, I want to be aware of that. I want to know that the VWAP has changed because of that, and so I'm going to incorporate those in there, so it may be a little bit different. But so just be aware of that. All right. So you can get it on eSignal. You can get it. I think you can get it anywhere, any chart, any. If you're a professional trader trading on a direct access broker like TradeStation, IB, any of these Speed Trader or any of these guys, any of these outfits, they're going to have the volume average price for you. So using remember these two things: above the price but not far away on a gap up can be considered bullish. And also below price but not far away on a gap down can be considered bearish. So if you're going to get short in equity that's gapped down and the VWAP is like a buck away, I would say no, because I want to try to get short as close to the VWAP as I can, because if it gets too far away from the VWAP, I think the stock's going to be too extended and can potentially bounce and stop me out. In the same way on a gap up, if the stock's gapped up and it's far away from the VWAP, I'm not looking to buy it. We'll wait for a pullback like the Pandora one. So remember, you want to try to buy and sell near the VWAP, or on the other spectrum, if the stock gets extended far away, either up or down away from the VWAP, you want to look to be, if it's far away on the upside, you want to look to short it so it comes back in. And then also, if it sells way off, you want to get the bounce into it then. So using the VWAP as a mean when price gets far away is ideal for nice reversal plays. Using this shorting the rip or the dip down on momentum, buying the dip down. Reminder, the VWAP is a guide to show you what the other bigger players are doing as price gets near it. So using it as a guide for entries and for price targets on reversal rips and dips is advantageous to you as a trader. So I want you, if you're trading gaps and you're trading with me on my Twitter feed, I run a Twitter feed subscription service. I used to run a trading room for 5 years, and it just became too time consuming. And so basically I moved my room to the Twitter, which is a private Twitter feed, and I call all my trades on the Twitter feed. So if you want to be part of it, it's a really small price, $99 a month, which is under $100, and little money out of your pocket. Pays me for the service I call trades, entries, stops, targets, management. I included it all on there. So we make money every week. But anyways, I hope you've enjoyed this. I would recommend from using what I put together here is to just pay attention to it. Okay, I've given you some guidelines here on how to use it. I've given you what to watch for and to use it in your trading. Now, everything I've given you is the guidelines I use. Now, like I said, I keep it simple. KISS. Keep it simple, stupid. But you're not stupid, you're very smart. So I'm going to say keep it simple, smart. Because you are smart, because you're a trader, and most people can't trade. And if you have money, you can trade, and that means you've done something right in your life. And so I would recommend watching it as a guide and use it to know when price gets far away or when price is near, and you look for entries to get long or short. All right? So email me any questions. I hope you use it, incorporate it. I used to use moving averages a long time ago. This is not a moving average. This is a benchmark that the institutional traders use. And once I found that out, I wanted to incorporate it into my trading because I knew this is where the bigger players. Because I'm basically trading with these guys. If they're not there, I'm not there. So when they're in there trading, I'm trading with them. And so institutional traders are our friends. We trade with them. They sell, we sell. They buy, they buy, we buy. We don't want to be buying. We don't want to be buying when they're selling, and we don't want to be selling when they're buying. We want to trade with them. Okay. Email me at Troy Gap Edge Trading, and have a fabulous day.